Peter Tchir is with me here in studio. I'm happy to announce, head of macro strategy at Academy Securities, the Honorable Mr. Tchir presiding in Chicago. Great to see you, Peter.
Great to be here in person.
All right, so we just went through this regional bank thing. Let's go there first because, like I described, it's like these obvious potholes on the road, but it seems like we can swerve around them or someone comes in and fills it in for us.
Yeah, I think they're can be reasonably contained. So one, real estate's always local. So it's going to be certain banks, small banks that are exposed heavily to regions that maybe have done poorly or got over-levered at the height of the boom. So New York, I think, is an issue. Illinois is potentially an issue. But they're small, they're contained. The regional banks themselves are fine. And these problems, I think we all forget, even the great financial crisis and the mortgage market, that took 2 years to collapse, right? It started in 2006, bounced around 2007, then you had 2008. So there's plenty of time to correct these things, and I think the commercial real estate will generally be corrected. Maybe there'll be a few issues here or there, but I don't think it's going to be a big roadblock to the recovery.
Okay, so you don't think this is a ticking time bomb in the stock market or the economy?
I do not, actually.
Okay.
Normally I'm happy to be bearish, and I'm bearish the market as a whole right now, but that's not one of my good reasons.
The context here is that you are kind of uniquely cautious, bearish. Describe to me your equity stance, because I see one of your notes that talks about $1 trillion mistake, and I feel like maybe that has some insinuations about the AI stuff.
First I'm trying to get rid of this whole Mag 7 moniker, right? It hasn't been true pretty much the
it
entire year.
doesn't work anymore.
Right, and now I'm hearing Fab 4, maybe today it's the Three Musketeers or whatever. I think the reality is it's all been about AI and what we're calling AI deputization, where people realize, oh, this company, whether it's Dell, whether it's NetApp, may benefit more from the adoption of AI than we thought. So that's all been growing. The two questions I have is, one, are they growing too fast? Wall Street, we get a lot of things wrong, but they've been wrong by $1 trillion this year on NVIDIA market cap. Maybe we are all wrong. Maybe the market's got a bit ahead of itself. So that's why I'm watching, because really the market's being sustained by that. And the big underlying problem to me has been, I think what we are seeing, everyone talks about China as though China's dead. The reality is China is going to work their way out of this, or they're going to try to. Maybe they die. And our view, and we've talked about this before, is we're seeing a shift of made in China to made by China, where China is going to try and sell their brands. I think it starts within China, where what they'll try and do is suppress the sales of US brands or European brands, up China sales of Chinese brands. I think we're already seeing some of that, whether you look into the EV space, whether you look into the phone space, and I think they extend that to the emerging markets, right? If you're a country that's in trouble, you can't convince people to manufacture in your country, well, then you have to sell your brands globally, and the emerging markets are, to me, a very natural place because they have trade deficits. China has trade deficits with them, so they can offer them discounts, they can offer them deals. China's got good shipping lanes, they spend a lot of time getting into the ports. I think that's going to be the shock to the system, is all of a sudden we're going to start hearing about Chinese brands, just like on the Super Bowl. Was it Timo or something we heard 4 or 5 times from?
This is very interesting. This is a very unique take. It seems like a lot of things that you've spent time studying over the years are kind of coalescing into this moment, because I know you've studied China a good bit. It's always in your analysis. It's always on your, as I call it, the risk radar. And I guess you would argue then that some of the concentration in our market cap around these big tech companies is because China has been beaten down so far, and that if they resurge a little bit, it might be more one-to-one than it has been in the past, a little bit more zero-sum than in the past.
Right, I think really, and so when I work with 18 retired generals and admirals, so China's been a big focus. When we think geopolitically, there's the tactical issues of what might be going on in the Middle East, but strategically, longer term, it's all going to be about dealing with China. The chip wars are real. That is going to be an ongoing concern. And now,
AMD can't make their chips bad enough
to
get approval.
Right, so you've got to kind of get something that you're going to wedge in. And it just feels to me that right now we're in this mode that, oh, the Chinese economy sucks, that's bad, and that's why sales are poor in China. I think that's a big part of it. But people are like, well, China's not going to recover. This is the Communist Party that's in charge, right? The Communist Party has every interest in staying in charge, and they cannot lose the middle income, right? We saw what happened when you started getting protests about COVID. All of a sudden, China flipped on a dime from COVID's awful to, oh, we can travel anywhere, and you guys are all crazy for not letting us fly to your countries. So they will respond to pressure. So I think they need their market to do well. But the reality is, if you can't get people to produce there, if your own consumers won't consume, partly because of the real estate, well, your only real option is to build your products and sell them. And you look at some of the technology they built, right? 10 years ago, I don't know what their phones look like. They're much better than they used to be. They have 7-nanometer chips, which is awkward since we're supposed to be restricting anything less than 10 nanometers. How these things are happening, we don't know. But I think that's going to be the shock to the system is China's evolving in front of our eyes, and we're still treating it as the China circa 2010, and it's now a different China.
It's interesting because right now that could arguably be used as an explanation for why Apple has been so weak next to the rest of the market. We are at, I think, 11 to 12-year lows in the correlation between Apple and the NASDAQ. I ran it the other day. Very, very unique underperformance by Apple. Then we get the headline that their sales are soft in China. It's not necessarily a pure macro thing. It's because Huawei is being bought again, and they have competitors. So is that the argument then, that right now the market cap skew is unrealistically favoring U.S. tech and China will eat away at that?
Right. I think we've taken this view that we will continue to sell our tech, our products globally. And I think China is coming up with better and better products, whether the quality is the same as ours, but the price point's also going to be very different. I think they're going to compete on price rather than overall quality. So I think their quality has improved. They've had years, and to some degree, right, we ceded manufacturing to China. Right? China is probably better in manufacturing many things than we are now, because for the last 20 years, we've let them do all the manufacturing. So I think we've not been thinking about competing with Chinese brands. We've always been thinking, you know, this company versus that company, mostly domestic, maybe Western Europe. And I think as these Chinese brands try and make inroads, that is going to eat out of our sales, out of our brands, and out of our market cap, because that's going to destroy some of the growth story too.
Well, at one point, wasn't NVIDIA's market cap like the entirety of the Hong Kong exchange or something like that, or one of the Chinese indexes?
Yeah, and even going back to your prior question too, BYD, I think, outsold Tesla in Q4. Now, it was mostly in China, but you know, we started talking about this probably 9 months ago, and in the last month or so, Elon Musk keeps talking about if we don't put tariffs on the Chinese auto manufacturers, they will take over the world in auto manufacturing. Now, he's probably being a little bit over the top to make his point, but these things are happening, right? China is developing EVs. China has a lot of the battery technology. They have some competitive advantage. They've set up, weirdly enough, I think we should be using Mexico more, but China set up a lot of factories in Mexico already to get around these tariffs. So we're going to have to aggressively do this, and I think we have just taken too much of a laissez-faire view towards what China's doing, and not understanding that China's trying to evolve. And I think those are some of the names you've talked about. We're showing the first signs of that potential risk.
Very interesting. In terms of surprise, you know, weaknesses in the armor. That's an interesting one. The idea that our market cap is skewed way beyond the real economic advantages versus disadvantages. What's the best way to play it? I mean, do you go long China as part of it? Do you short U.S.?
So right now I am long FXI, short QQQ, which, believe it or not, has actually worked from February 1. You tell people that, and that's got to have been a disaster.
You're such a proud American and patriot, too. This is a, you know.
And I've got to admit, I do think I viewed China for 2 years as uninvestable.
Yeah.
I still think it's uninvestable, but it might be tradable.
Okay.
So I think you have the short-term bounce because I think everyone's gotten so outside of China. Longer term, I don't trust that China will reward foreign shareholders. I think they will look for ways not to respect that. So I would not be a long-term investor in China. I am not looking to add any businesses in China. But I think for a trade, look where FXI is. And what cracks me up is literally if you pull back, going to February 1st, FXI has outperformed QQQ, and most people would say offhand, must be completely crazy.
Right. No, that's a good point. Okay, because it kind of looks like the bottom might be in for the China stocks. Of course, we've been fooled before as that chart's been really brutal. That answers a lot of my stock questions. Before I let you go, though, give me a macro thought here. The strength of the U.S. economy, can it continue? Can it remain above 3% for long?
You know, I don't think so. I think we're seeing some weakness in jobs. But again, I think we're going to move along. I think we're moving in that okay space. AI has been a huge driver. I think for the next 3 to 6 months, what's really going to drive the overall market and the economy is, do we really start seeing cost benefit and efficiencies coming out of AI? Does every company that has invested and spent money in AI come out 6 months from now and say, this was the best investment we did? Or do they say, hey, this was great, but maybe AI is still a little bit immature relative to the cost of implementing it? And that's going to be, I think, the next big driver.
That would be a tough pill for the market to swallow, for
At this
sure.
point, unfortunately, yes.
Great conversation, Peter. Great to see you.
Great to see you too, thanks.
Thanks all for coming in. Great to have you in Chicago. Peter Tchir, head of macro strategy at Academy Securities. All right, really interesting take on the relationship between U.S. stocks and China.